So what does DirecTV think about this? Let's ask the chairman and CEO, Mike White. He joins us now from Los Angeles. Mike, welcome to Bloomberg West. Thanks so much for your time. Let's pick up where Joe Clayton left off. What do you think of what Joe had to say?
Well, you know, John, nice to be with you. We've got a clear and focused strategy that we shared with our investors in December that, you know, we're very excited about: growing our core business, dramatically expanding in Latin America, and buying back stock. And it's worked pretty well for us. And, you know, we think it is the right strategy for DirecTV. Now, you know, look, I think all of us in a changing environment are always looking at opportunities to create shareholder value. I think, frankly, the regulatory environment is, I would say, would be challenging. A lot of things have changed from when this was originally proposed 10 years ago. The telcos have come into the business and made it more competitive. But you also still have kind of some challenges in half the country, I would say, from a Justice Department standpoint, even though I think, frankly, you know, the biggest issue that our industry faces today is more content costs. But so I'm a bit concerned about whether it be even a regulatory possibility in the current environment, to be honest with you, in Washington, D.C.
And I'm not going to ask you to be a regulatory lawyer, but if AT&T is able to successfully buy T-Mobile, would that create, do you think, an easier environment for you to at least consider a deal like, say, DirecTV and Dish coming together?
You know, that's really speculative. First of all, they're completely different industries. I suspect the wireless, they're going to look at it as a national market. They've made it very clear in the case of video. They look at 4,500 or 4,600 individual local markets and try and assess competition in those. So, you know, I think it's quite a different proposition.
All right, I want to bring our editor-at-large, Cory Johnson, into the conversation. Cory's in our newsroom. Cory, take it away.
Yeah, Mike, look, when you look at the two businesses, they often get lumped in together by Wall Street. When you look at your competitor, Dish, in what ways is their business different than yours?
Well, look, Charlie Ergen runs a terrific organization. You know, he kind of built that business from scratch. They have certain strengths. I think we have certain strengths. And we both go toe-to-toe, and competition makes us both better. You know, I come from the soda industry, where we always said that the Coca-Cola company made PepsiCo a better company because of competition. And I think the same is true between us and Dish. We have a healthy competition. You know, what I believe our strengths are is, you know, we've got a terrific brand. We do a great job on customer service. We can get better at that. We need to get better at that. But, you know, we've kind of had the best ratings on customer service over the years. And we continue to work hard to earn that. And I think we've got the best technology platform in terms of our business. And you know, we've been adding more subscribers in recent years. And then we've got a fantastic growth opportunity in Latin America.
Coke and Pepsi didn't do much for RC Cola, but I'll leave that issue aside. You know, we've been talking in the first half of the show a lot about Groupon, and one of the issues is the permanent value or the lifetime value of a customer. When you guys look at your business, customer acquisition costs are a big deal, churn is a big deal. How do you assess the lifetime value of a customer, and how hard is it to get to that number?
Well, we have a very sophisticated modeling group that looks at lifetime values segment by segment, customer by customer, and we'll constantly be fine-tuning our offers in terms of where we see that going. Clearly, as our industry has become more competitive, you know, the price of adding a new subscriber has gone up. But suffice it to say, it's still well above our cost of capital. We still believe we're creating significant shareholder value, and we had a terrific first quarter in terms of gross adds, and we're continuing to work hard to win new customers to the DirecTV platform. But it's, you know, we look at it component by component. We're constantly looking for ways to improve our lifetime value, but, you know, we're quite pleased with it today.
Mike, I have one more. It's John Erlichman again. I have one more deal question for you. You mentioned the competition. AT&T and Verizon have spent an awful lot of money to get into this business. Could you see a day when they might just think it's easier, if they could get the regulatory thumbs up, to buy a company like yours?
Well, I wouldn't speculate. I mean, that's a question to ask the CEOs of AT&T and Verizon. We have an excellent relationship with both companies. They're both important partners of ours in terms of the bundles that we put together, the broadband bundles. You know, suffice it to say, I think DirecTV can add even more value to both AT&T and Verizon both because I think of the quality of our technology, our sound and picture are the best. I think our costs are the best in terms of programming costs. And to be honest with you, we're looking for ways to expand our partnership with both of them, and would love to find ways to build on the relationship that we have.
Speaking of programming, you guys just launched a service where movies 60 days after they get out of the theater can be available for something like $30. The first movie you guys offered was Just Go With It, an Adam Sandler movie. What can you tell us? Are people buying at $30 a pop?
Well, we're getting a few folks to try out this new service. I think it's still early days. You know, we haven't done a massive ad campaign. We've been sensitive to kind of our relationship with the studios in that regard. And I think, you know, we'll see as movies come. I think it may work better for kids' movies when you're going to have a party and have a bunch of kids over. But we're enthusiastic about giving it a shot and seeing what kind of consumer take there is.
Mike, a lot of people have looked at this very impressive Latin American strategy from you and point to the success you've had in the stock market, the return for your stock. Do you think that you're getting all the credit in the stock market that you deserve for this strategy?
Well, I think we're getting more credit than we were getting when I became CEO of DirecTV, and I think that's in large part because of, you know, we've been more aggressive at trying to communicate our story. And I think, frankly, it's a little bit of chicken and egg. We've got a better story to tell, and we're communicating it more aggressively now. But you know, I think we're well on our way. But I'd say I still think it's a gem of an asset, and really, I still think we've got tremendous growth ahead of us.
I asked that question because I know there are some analysts that have said, boy, I wonder if they should just spin off that business, try to get more value from it. Have you thought about doing that?
Well, yeah, that was suggested to me when I became CEO, and I kind of looked at the asset. I'm pretty familiar with international guys. I spent most of my career at PepsiCo working over international, so I know the Latin American markets quite well. We have a tremendous competitive advantage in Latin America, even more so than in America. If you think about it, you think about this country, you got fiber optics, you got all kinds of choices. But in Latin America, our satellite technology is fundamentally advantaged. And if you look at the macros in a country like Brazil, I think under Lula they added 35 million people to the middle class, and that's going to continue to expand in the years ahead. It's a very young population. It's exactly the kind of population that's right for DirecTV.
All right, let's bring Bloomberg editor-at-large Cory Johnson back into the conversation. He's in our newsroom.
Mike, I'm talking to some investors in your company, and when they look at the space even wider, they start to look at new areas of competition. That, of course, the name Netflix comes to mind, but with new places that consumers are able to get video, put it on their TVs that might not involve DirecTV, might not involve cable at all. When you look at the landscape, how do you look at Netflix, and how do you look at the rest of the competitors coming in your way?
Well, you know, it's interesting. I think you have to look at all of those things. I think you have to look at Hulu, Netflix, Google, Apple, in addition to all of our traditional competitors. And we do, as we've put our strategy together. I think the interesting thing is there are a lot of things that Netflix does well that we think we can also do. I think we've expanded our video on demand options for consumers. We're expanding our kind of TV everywhere offering. We're going to roll out a whole new user interface later on this fall. And, you know, if you can't beat them, join them. So, I mean, in my mind, it's a little bit of a different game, however. If you want current sports, if you want the hottest American Idol show, you've got to have a paid television service like satellite and DirecTV.
So let me ask you, if I'm looking at your income statement, and I'm going to imagine, you know, I'll take seriously what you just said. Where do I see the changes in your spending? If I'm looking at your income statement, if I'm trying to understand how your business is evolving to face down these new threats, where do I see that?
Well, if you look in the U.S., you'd see it both if we announced a higher level of capital spending this year that was specifically going to both engineering and IT. You know, we've added a substantial amount there of increased spending for those two functions. You'll see that in the CapEx. Within the P&L itself, you'd see it in, you know, kind of the investments in our broadcast centers. You'll see it in our higher SAC costs, which are higher because of the advanced technologies that we're putting in the consumer's home, including
SAC costs, just a jargon alert. I want to jump in. SAC costs being subscriber acquisition costs. I'm a walking dictionary here. I'm here to help.
Sorry about that. Yes, subscriber acquisition cost. You're right. So. You'd see it there.
Mike, you mentioned sports, so important to you guys. Cory was in Los Angeles yesterday asking the question of what it means to EA Sports. What about to DirecTV if there's an NFL lockout? You've said cash flow could take a hit. Give us specific numbers.
Well, you know, the NFL is a very important partner for DirecTV. We've had a long relationship with them, and, you know, we look forward to a great future ahead. Having said that, clearly, you know, I think we're going to have to see where things go. I'm still optimistic that we're going to have a season. It may take till late summer or early fall before things get sorted out. I think we'll learn a lot more in the coming weeks once the judges render their decision. But I'm still optimistic in the end, you know, that both sides will come to an agreement. Look, there's all kinds of you tell me they're going to miss a game, they're going to miss 2 games, they're going to miss the whole season. If they miss a game or 2, it really doesn't change our numbers much. Everything becomes kind of pro rata. If they were to miss a whole season, you know, there are certain provisions in the contract. It somewhat depends on how the NFL chooses to exercise their rights. But suffice it to say, actually, from a earnings standpoint, we'd be better off. From a cash flow, might cost us a little bit because there's a provision that allows the NFL to advance some payments from next year into this year, but it's a one-time thing. We get an extra year on the back end of the contract. So I don't really think it fundamentally changes how I look at our strategic prospects at DirecTV.
But if the season were wiped out, you mentioned cash flow. What's a specific number? What's the worst case there?
Well, I think the worst case would be they'd advance some payments into this year. Net might cost us $100 million this year that we get back in 2012. And frankly, we'd probably be able to cover at least half of the $100 million this year with some, you know, improvements in the way we manage working capital. But I really don't expect that. I think that's kind of not likely, to be honest with you. And whatever would cost us this year comes back in 2012. It's strictly kind of moving it from one year to the other.
It seems to me that if you get an extra year put on the end of your contract at this year's price, you know, the price of rights to broadcast NFL games has done nothing but go up. On some level, that would be a good thing for you, yes?
Well, no, I think a good thing for everybody is for them to play their games this year, and we're looking forward to a great football season. You know, we've told our NFL Sunday Ticket folks, you don't pay until they play. You know, we're optimistic and hopeful that there will be a season. So.
Well, Mike, we really appreciate your time. Thanks for joining us. Look forward to seeing you here in San Francisco next time. Appreciate it, Mike White, the CEO of DirecTV.